Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admiral Markets. It is a Friday. It's the 20th of November, 2020. And today's topic is why and how to invest in dividend stocks. So for a topic, especially I think for investors, mainly investors, even though dividend stocks also play from time to time, certainly an important role within the portfolio, long-term portfolio of traders, active traders, but also based on dividend strategies. Today, we want to especially focus on the basics of dividend stocks and why I think these shouldn't miss, or is that right word? Why dividend stocks have a place within everyone's portfolio, in fact, whether it's an active trader and it's a long-term portfolio or it's an investor in general. So before we start, let's have a look here at today's agenda and what we want to look at today. So first of all, we want to answer the question, what are dividend stocks? Then we want to point out the advantages of trading in dividend stocks. And then certainly we also want to point out how to invest in dividend stocks. The thing is, and this is probably very interesting, that's also true for active investors in this case. Active traders also, even though it's not necessarily sad that you can profit from it on a short period or a short time frame, let's say, but sometimes you might have heard that you should look for, or that a dividend stock is very attractive based on a quite high dividend yield. And we want to here today, and these are the last two bullet points within the agenda, we want to point out, first of all, the key metrics of dividend stocks. And then we want to point out, and I will show you that a high dividend yield isn't necessarily everything. Probably sometimes it's a reason to be a little more careful, let's say, and think about an investment within such a dividend stock than twice. So before we start, first of all, my name is Jens. So I'm the moderator here today. And if you're interested in my Vita, I don't want to go through it. Please have a look here, especially if you watch this video now on YouTube. Check out the description box. There is a link to to an interview I did together with Admiral Markets some time ago. So my Vita hasn't changed, in fact. And just find out within this interview where I come from, how I got started in the world of finance in general. I started out working with a bank, for example, but soon realized that trading is the place I wanted to be. And I had I got lucky due to my former girlfriend. Her father knew someone who was a stockbroker, and that way I made my way into the world of trading then, in fact. And I started out as a professional trader, in fact. So in this case, as a market maker and quoting stocks, and in this case on a stock exchange, and took it from there then. And the later developments then are all pointed out within this interview. Also, how I got started in the world of trading, let's call it prop trading probably, or trading my own account probably. So that wasn't the professional, but the classic retail way then I took there. What's probably nevertheless most important, and this is exactly where today's broker here, the host of this webinar, Admiral Markets, comes into play. I'm located in Berlin, in Germany, and Admiral Markets is in fact a broker which is a really global provider of financial services, in fact, especially I think it's fair enough to say a big player in the CFD and FX industry. In fact, here you can see it's 18 years of reliability. In fact, it's right now it's 19, and we are about to make it 20 the next year. And Admiral has, in fact, 20 offices around the globe, one in Germany and one here exactly in Berlin, in fact. So it takes me probably 20 minutes, 25, to visit the office. And that's noteworthy because you have real humans here within the office, and you can talk to them. You can ask them your questions in your native language. And this is especially noteworthy, something where especially retail banking, let's say, comes into play. That's where I got started, and as a trainee in a bank. And I realized that people who are not familiar with the German language have sometimes not just trouble to articulate themselves and talk about a certain topic, especially when it comes to finance and important questions here, but don't feel really comfortable talking to someone in a bank in general. In fact, if this person is not talking your native language, I know from a law office perspective and everything. So especially banks want to make sure that everything's cool and fine there. But still, it's a solid fundament you can build a relationship with a client based on. And having over 20 offices around the globe is definitely crucial for the success of Admiral in the global financial world, especially in the CFD and FX industry here. Beside the fact that here in Germany, for example, when it comes to Admiral markets, we are referring to them as the DAX expert, for example, having the probably most competitive offering, most attractive offering when it comes to the spread in the DAX, respectively, when it comes to commissions in FX, respectively, also the spreads, the tightness of spreads. We had several weeks ago a webinar on how a broker makes money, in fact. And there I pointed out several points, what to look at if you choose your broker. And yeah, Admiral is everywhere, really among the top providers, financial service providers. And that's one of the reasons why it's definitely worth, after that webinar here, to probably check out admiralmarkets.com for further infos on the financial services being provided from Admiral. Today, now we want to look here at the dividend stocks. By the way, FX CFD, that was what I pointed out now. Some of you might probably wonder now, okay, cool, an FX and CFD broker, leverage product. Why exactly do you do a webinar on dividend stocks then? It has to do with the fact that Admiral is in fact a multi-asset broker, which means you have a solution here, which is called Admiral Invest, where you can invest directly into physical stocks. So you can own these physical shares. In fact, very attractive conditions also from a commission perspective. And also here, dividend stocks play an important role. We want to have a look at these in the upcoming minutes, in fact. And this is how Admiral also plays a role here within this dividend stock, let's call it universe, probably. So what is a dividend stock? So a dividend stock is any stock that pays out dividends to shareholders on a regular basis. So dividends are usually paid by well-established companies due to more predictable revenues and earnings. So that's something which is probably of interest here. Some might smile now because a company like Amazon, for example, does not pay a dividend. That's probably very interesting. In general, you should be really careful when it comes, when it comes to growth stocks. So these companies, they sometimes have a tremendous development when it comes to the rise in the stock price, in fact, but some of them need this massive rise, in fact, and this is something growth stocks are known for, let's say, because they don't pay out a dividend, since they have, in fact, trouble to predict their revenues, respectively upcoming earnings. That's one of the reasons why such developments as we've seen recently, for example, in Tesla. Yesterday, for example, we pushed again back above I'm sorry, no, that was the other price before the split of 5-1. We pushed above 500 USD per share. That would have equaled 4 months ago to a stock price of 2,500, in fact. And some might wonder if this is fundamentally, if it's a fair value, or if it's not more like, let's call it bubble, we get to see there. Well, it's difficult to call it a bubble because classic metrics you use to, for example, like a PE ratio, let's call it directly a PE ratio in this case. It's very, very difficult to say whether we are in a bubble or not, since we are looking at a classic growth stock in this case. So that said, it's very difficult to predict the revenue, respectively earnings, what is fair in case of evaluation, a fair value for the company based on the fundamentals. And that said, in fact, it gives us these developments we currently get to see here, these parabolic rises, especially in the electric vehicle and universe, for example. So we're especially looking here on Tesla. You could do the same on the direct Chinese competitor. I think we can easily call it NIO, for example. There's also Li, for example, another Chinese company here within this industry. So it's a very, very hot sector right now, the electric vehicle sector, but usually a sector which you won't see paying out dividends due to the fact that it's a growth sector, and due to the fact that it's very difficult to predict revenue, respectively earnings here, something which is usually something you will get to see in well-established companies who established their names, let's say, over the last century, for example. Companies like Exxon, for example, or I think Disney is also paying a dividend, for example. So, and let's have a look at some industries which are well known for paying dividends, among others, certainly. But let's have a look here at the well-known industries. So first of all, financial companies. Why do I smile? That has the reason, a simple reason, because I think times have changed a little, let's say. So financial companies will likely not pay out a dividend, especially in the US, but also in Europe, I think, for quite a while, given the developments around Corona. I think we all agree on that. In Germany, there's Euro-critics, some very, let's call them hardliner, who all the time already pointed to the developments in the Eurozone and said that this is not sustainable, what we get to see here, especially after the launch of QE from the ECB, manipulating the yield markets, pushing yields, for example, for Italian bonds here to 1% and even below that level, and aggressively manipulating here the yield market, in fact. And well, what did we get to see due to this? I mean, yeah, obviously there are companies out there who had already trouble to establish a profitable business. And these companies who had trouble to establish the profitable business, even well, thanks, they were still alive, let's call it that way. They were still alive thanks to the fact that yields were at nearly zero for now quite a while. And so imagine you have a bank here, and the bank is giving out a loan to such a company. And the more loans you hand out here, the more problems you get once you have the Corona lockdown, and now the cash flow drying out, let's say. So for these companies in this case, so these companies, they had already trouble to establish good customer relationships, let's call it, or to realize an attractive cash flow to paying out or paying back the loans, in fact, which is now the problem of the banks who are waiting for the loans getting paid back, or where the loans are not getting paid back. And the outlook on this, in fact, so here in Germany, now we close the cycle here. In Germany, for example, it's an open secret, in fact, that banks are they're insolvent. They have only some smart tricks, let's call it, to keep their business going, in fact. But all in all, banks would completely collapse once there wasn't this rule that you're allowed to value a loan or to expect a loan you get repaid the loan, the amount you handed out to the company. You can say we still expect to get repaid from the company, since it's only Corona why they can't pay back their loans right now. So, and that's one of the reasons why financial companies, respectively banks, are currently not allowed to pay out dividends anymore. Because here, that's one first step where you can see that the well-being of banks, or in general financial companies, especially in Germany, but also I think over the whole European hemisphere, the same is also true for US banks, where you can say that these companies, financial companies, usually have lots of trouble, and thus they not allowed, in fact, to pay out dividends anymore. That was the reason why I smiled. Healthcare companies, right now, especially a big topic, certainly, which is certainly true when looking at companies like Pfizer, for example, right now with COVID-19 vaccine news, which make rounds. I'm not really sure whether Moderna is paying out a dividend. I have to look this up, in fact. I'm also not really sure whether a company like BioNTech, it's a German company, I think I think it's BNTX. I think I'm not really sure whether you can trade this via Admiral Markets. In fact, you can trade Pfizer. It's PFE. I'm not sure about Moderna. Usually you should. It's mRNA, I think. But all in all, usually these companies pay out a dividend. Then we have utilities here, but also energy companies. I already mentioned, for example, Exxon. You have companies like Chevron. I don't really know whether they are still allowed and fine to pay out dividends. I think, especially when you saw the developments around Exxon, for example, they were kicked out of the Dow Jones, I think, after something like nearly 100 years being within and being such a well-established company. I think also that Exxon is one of the so-called dividend aristocrats. This is a company which increased the dividend by 25 years steadily every year, if I'm not mistaken. I think this is a definition of a dividend aristocrat in this case. But let's come back to the topic. So these are industries which are well known to pay out dividends, in fact. And now what we want to do is we want to have a look here, certainly, on the advantages of trading dividend stocks. So dividend investing is a strategy. It's a strategy for long-term investors, especially, that gives investors two sources of potential profit. So you have, first of all, a quite predictable income from regular dividend payments, so-called dividend aristocrats. Let me just see, did I have, this is beautiful. You know what? I have a link within the article. So now we can read up here, what is an S&P 500 dividend aristocrat? So the dividend aristocrats are S&P 500 index constituents that have increased their dividend payouts for 25 consecutive years or more, as I said. And so let's come back to the presentation here. 1 second, there we have it. And so first of all, you have the quite predictable income from regular dividend payments. By the way, let me just switch back. Probably, I think we also have a list here of companies. So we have AT&T, for example, Colgate Palmolive, we have Franklin Resources, we have T. Rowe Price. Just see. Why did I thought it was Exxon? Where did I read Exxon? Let me just see. ESX. Oh, that's interesting. I thought Exxon is also dividend aristocrat. That's very interesting. Financials 10%. Okay. However, so if you're interested, check out the chat box, please. Let me just enter it here. You can also find the link here. Let me just see. You can also find the link. Dividend aristocrat. So for further information, just check out the following link here, the Wikipedia article. And now let's go back to the presentation. So quite predictable income from regular dividend payments. And then we also have, in addition to that, since we're trading a stock, in fact, potential capital appreciation over time. So speculative gains. They are not as, let's say, aggressive, as you might expect it in a growth stock, per definition, in fact, but still over time, you definitely can certainly see such a capital appreciation over time. Oh, thanks for that. So now now I see it. Thank you, and thank you to Andre and also Opera. Thanks. So that's perfect. Okay, thanks a lot. So Exxon is within the table. Then I haven't seen it. I just how do I say that? Over scrolled it, but then Exxon is included there. So I was quite sure, in fact, that Exxon is a dividend aristocrat. So. But let's come back to the potential capital appreciation over time. So these are two potential income sources if you trade dividend stocks, even though it's more the longer term you look at here, but still, this is something which is also very interesting for people who try to build a portfolio, let's say for their retirement. Let's call it the retirement portfolio, where they have these continuous capital income streams they get paid out, the dividend, they get paid out, and they can build their retirement on, in fact, and I don't know, well, have some fun with the dividends being paid out if they build a portfolio of dividend titles and stocks over time, in fact. So buying dividend stock is not only attractive for investors looking for generate such an income, as I already mentioned, retirement, for example, but also for those simply looking to build wealth by reinvesting dividend payments. So there is some also, it's a very interesting aspect. Some indices, for example, the DAX in Germany is a so-called performance index. So once the companies pay out a dividend, it's directly reinvested into the DAX, in fact, and resulting in a classic so-called compounding effect. And sometimes people don't do that. Probably they do it till a certain point. Let's say they have dividend payments and they use the dividend payments to invest it in stocks again and create an even bigger portfolio over time then. And once they retire, and they say, okay, now I built wealth by reinvesting, especially the dividend payments. But now I want to see my income, or I look at the dividend dividend stocks in my portfolio as an income generator, in fact. And yeah. In addition to that, that's also very interesting. I'm not a tax advisor, so I won't go into details here on this topic. But in addition to that, investors also might consider investing in dividend stocks for tax purposes. So that might also be a reason, and why dividend stocks for long-term investments especially is quite interesting, quite attractive, in fact, and considered by also high net worth clients in this case. So now the question, how to invest in dividend stocks? I mean, that's quite simple, I think. There are two main ways to invest in dividend stocks. So the first is by investing into the mutual fund, like index funds or exchange traded funds, ETFs. We also had a webinar on this that hold dividend stocks. So in this case, I now pointed out, for example, the EUDV. This is the ETF you can find once you look up the website from Admiral Markets, and there the Admiral Invest solution. This is here a Euro Dividend Aristocrat UCITS ETF, in fact, which is investing in the S&P 500, in the S&P 500 dividend aristocrats in this case. And why did we call it Euro? Because there's no exchange risk included anymore. Because while the S&P, the classic dividend aristocrat ETF, certainly invests in US dollar, this exchange risk is already hedged by the portfolio manager / the ETF management company in this case, by selling USD and buying euro, so that there is no capital volatility in your income stream resulting out of swings in the underlying currency in this case. So there's no currency risk included. So this is the first way to do it, in fact. And the second, simple, you just purchase the individual dividend stock, like Axon, like AT&T, for example, and take it from there, in fact. And holding a position over a date when a dividend is paid, this is something which results sometimes in irritating developments, let's say. So let's put it that way. So we already had Tesla. Let's probably use this as an example. You probably have heard about these, let's call them Robin Hood traders, for example, which made some news, let's say, over the course of the last months after the Corona lockdown. And then these young guns, let's say, coming into the market and building from time to time highly leveraged positions. In fact, classic retail trader, and but having no really clue what they're doing there. And what happened then was that in August, there was this stock split. And you probably have seen the developments in the Tesla stock before. So the stock rose significantly, way higher and higher, and above 1,000 USD per share and even higher. And then there was the stock split of 1 to 5, which meant that all in all, market capitalization was not affected, but the split resulted in let's say a stock price of 2,000 USD per share to drop to 400, even though you haven't lost here 1,600, but in fact had now 5 times as many stocks within your portfolio. So why do I mention that? Because someone who doesn't know what he's doing looks at the portfolio at the next morning, looks at the stock price and sees a drop of 80% and probably more after stock split in Tesla. And is going crazy because he thinks that the world is going under and all his money is gone because Tesla just lost 80% of market capitalization, which is not the case. Something similar is happening, in fact, once you have a dividend title within your portfolio and you hold it here over date when a dividend is paid, in fact, because this will result in cash adjustments reflecting the weighted effect of dividend payouts, meaning that your account will be credited the dividend amount, in fact, while the stock price will drop. So just assume, so that will naturally mean that the dividend amount per share is offset then. So just imagine you have a stock, let's say you have Exxon, and now we just say a price, let's say $20 that is before the dividend is paid, and then you have the ex-div day. So that's the dividend payment has taken place. It's the day after the dividend was paid, and then it's, let's say they pay $1 per share. So that means that the stock price drops by $1, which means nothing more than the stock is not 20 but 19 USD now, but you get $1 credited to your account, in fact, which you can then use to reinvest it into the Exxon stock, in fact. And from time to time, especially in a bullish environment, it's not uncommon that these losses, let's say, or that these offset amounts that they are made back, that there's kind of a some, for example, in the yield market and Bund future, you also see that after the rollover has taken place, big expiration in case triple witching, probably I've heard about this before, and from time to time, or not just from time to time, but there were gaps in one or the other direction, in fact, depending on where you price the yields now in the future. And then there was a strategy where you could show that the gap could be profitably traded. And something similar is in fact possible to formulate, even though a little more sophisticated, probably to some extent, in equities and in dividend stocks. But we won't dig too deep into this idea right here. Probably we do a webinar somewhere in the future here on this. Just to know, once you invest in the dividend stock and you hold it over the day where the dividend is paid, you will see a drop in the price, but the drop in the price will be credited in the equal euro or USD amount, whatever, into your account in this case. So now let's have a look at something I think really, really special, some key metrics here of dividend stocks. So first of all, we look at something probably many of us already know, the so-called dividend yield. So the dividend yield is the annualized dividend represented as a percentage of the stock price. For example, stock trades at $20 per share, with the company paying out $1 in annualized dividends. Why do I say annualized? You probably have seen that each quarter a dividend is paid. Some companies pay a dividend each quarter. There are also companies which pay a dividend each month. And annualized means that you take all paid dividends. Let's say you have, in this case, 25 cents per quarter you're getting paid. You have 4 quarters within the year. So that means you have 4 times 25 cents, which equals $1 then. So then you have an annualized dividend, in this case, of $1. And what you do is you look at the annualized dividend and then you divide it by the stock price and you get your dividend yield. In this case, it's 1 divided by 20, it's 5%, and thus the dividend yield in this case is 5%. Then we have another key metric of a dividend stock. It's called the payout ratio. The payout ratio is the dividend as percentage of a company's earnings. So for example, a company earns $1 per share. This is also something we know as EPS. In the next bullet point, we will introduce this, but I already mentioned it right here. So earning per share, EPS, if a company earns $1 per share in net income while paying, let's say, 50 cents per share dividend, the payout ratio is 50%. So that alone is probably interesting, but what can we get out of this as an information for us as an investor? Generally speaking, the lower the payout ratio, the more sustainable a dividend should be, in fact. So, which means it could be that a company is paying out high dividend in this case, just to attract investors' capital, in fact, and only for a short period of time, because overall, we should realize that the company needs to make money first before it can pay out a dividend. So the higher you pay the dividend payout in this case, the more money the company needs to make. If the business model of the company is not sustainable or is not as competitive as a high dividend payout suggests, in fact, we could argue or we could expect that rather sooner than later, the dividend has to drop because the revenue will naturally drop because the business model is not as advantageous as the company suggested in the first place. So that's definitely something to consider. Now, let's have a look at the earnings per share, as I already introduced it, EPS. So roughly speaking, the best dividend stocks are companies that have shown the ability to regularly grow earnings per share over time and thus raise the dividend. So this is where the dividend aristocrats come from, the name. So the companies which are considered dividend aristocrats have shown over time that they're capable of making money, profitably working or generating business, in fact, increasing the earnings per share, and thus we're capable of increasing the dividend they are paying out. So, and a history of earnings growth actually is often evidence of durable competitive advantages within the marketplace. So that's definitely something you want to take into account before you start to invest your money with a company in a stock, in this case, respectively, aiming for a stock. And here in this context, when you look for a company which is also paying out an attractive dividend, in fact. And at the end, we have the PE ratio. We already mentioned this too, PE ratio, growth stocks at the beginning, because you sometimes have really absurd developments there with a dividend, a PE ratio of something north of 1,000 or something. Price to earnings ratio divides, in fact, the company's share price into earnings per share. So which means nothing more. PE ratio is a metric that can be used along with dividend yield to determine if a dividend stock is fairly valued or not. But this is something which is not useful when looking at growth stocks. So that's definitely something you have to keep in mind. When you see someone, I mean, I myself sometimes had to laugh over the summer when these parabolic moves in growth stocks took place, these massive rises. We could also do a webinar on trying to explain what happened there. Probably there was some developments, the main drivers based on the options market. In fact, some of you probably have heard about the SoftBank and their bets in options in case. In this context, and that let's call them short seller, or those who sold the options, the long calls in this case to SoftBank, they had to hedge their exposure. So if, for example, SoftBank is aggressively betting on growth stocks to rise even higher and higher and higher, and it tries to leverage this bet by buying an option, just imagine you're on the other side of the trade and the option is the right to buy a share to a predetermined price, the so-called strike price. So, and now you have the problem as the seller of this option, you don't have the stock within your portfolio. So you can't hand it out to the a price which is determined within the option. So what you have to do is you sell the option and then you hedge your delta, you call it, and you buy the stock in the marketplace. The more options are bought in this case, the more stocks have to be bought. And on the other hand, and which means like if you get to see aggressive demand here and long calls in this case from a buyer like a SoftBank, but also we also already mentioned the retail traders, the companies, not the retail trader, who are aggressively leveraged, and I've just calculated within an example to show how you were capable of moving with only paying 1,500 in option premium in this case to move something like 500,000 in the marketplace as an individual, and we're talking about a small amount of 1,500. So just leverage or just put some zeros behind this, and then just imagine how big the value of this bet grows within no time, in fact, and how many shares have to be bought. And that alone pushes the price in such stocks higher and higher and higher. It's some potential speculative excess taking place there. Well, and then you have a PE ratio which is north of everything you could have dreamed of. And you sit in front of a screen just smiling. But this is natural for growth stocks. This is just natural for growth stocks. So if someone is standing in front of a camera on television, and is talking about the absurdity and that this balloon rather sooner or later will burst with a big bang, well, he might be right. But as a trader, we don't care about this. We just try to ride this wave and try to profit from the momentum, which goes naturally hand in hand with growth stocks in this case. But in addition to that, and we close the cycle right here. So we have to be really careful when we look at these developments here from a PE ratio perspective. This is unusual, let's say, for solid dividend paying stocks or dividend aristocrats, in fact. So this is completely different. It's just for, let's call it information purposes. So just to give you a deeper example or a deeper picture on what's going on probably behind the scenes here. What we want to do now is I want to have a look here at the dividend yield. I meant at the beginning of this webinar, and that high dividend yield isn't everything. In fact, you could have read this between the lines on the last slide already. Once I looked here in this context at the payout ratio, for example, increasing the dividend yield, increasing the dividend, which is naturally also increasing the dividend yield in this case to just attract investors' capital, but not being sustainable. So there will be now, what I want to do here is give you some ideas on how to avoid the dividend yield trap. So first of all, I recommend don't invest in a stock only by looking at the dividend yield. So, which means a high dividend yield, as I already mentioned, is probably the result of a massive drop in the stock price. That's also something which you should take into account. Look at the Corona lockdown several months ago, and then we've seen stocks around the globe dropping enormously, in fact, recovering quickly, but this is something we didn't know back then. And the drop in the stock price, why they haven't adopted there was no adaptation in terms of the dividend yield or dividend which is paid out, naturally resulted in the yield of spiking higher, dividend yield spiking higher. And all in all, usually such a drop in the stock price is a sign of trouble. So it's something you definitely should keep in mind. This is the other side of the coin in this case, when we look at rising the dividend just to attract investor capital, in fact. And also carefully look at the payout ratio, which helps you to gauge the dividend's sustainability. So all in all, it comes down to the payout ratios here in this case. Also, look at the company's dividend history. Once you plan to invest in a company which is paying out the dividend and it seems attractive to you, just have a look here at the payout growth and also the yield which was paid over time. So is this probably just a short-term development which is taking place, or has this taken place over the last, let's say, decade, for example? So the last decade obviously has a greater sustainability than if it's just a short period of time during this happens, probably initiated by a dropping stock price. And then in general, when you plan to invest longer term, look at companies which are solid, respectively solid from a balance sheet perspective. So in this context, for example, look at the debt, the cash, other assets and liabilities in this context. And also take a look at the industry, competition, potential weak demand, potential disruptions. Again, avoid to do this when it comes to growth stocks. So growth stocks are a special topic in this case. So something where it doesn't make sense to look at the balance sheet. In addition to that, most of the time, those growth stocks don't pay out dividends. So it's not a big issue, but something probably some listeners to this webinar now wonder whether this makes really sense or not. If you plan to if you plan to invest in dividend stocks, and here in long-term investments, you're interested in long-term investments, then I think a first interesting area here is to look at the dividend aristocrats to get a first, and I wouldn't say safe, but a solid first step into investing in dividend titles. And yeah, so in fact, that's nearly it. Let's sum up what we just learned. So first of all, a dividend stock is any stock that pays out dividends to shareholders on a regular basis. Very simple. Dividend investing is a strategy that gives investors two sources of potential profit, which is one of the main reasons why it's attractive. First, you have a quite predictable income from regular dividend payments, so-called dividend aristocrats, as I shared the link with you. For further details, just check out the Wikipedia article. I think that is quite self-explaining. And then we have potential capital appreciation over time. So speculative gains, which are also a source of potential income once you plan to sell the stock at a price in the future for whatever reason. Then let's have a look here again at the key metrics of dividend stocks. They are the dividend yield, they are the payout ratio, they are the earnings per share, and they are the PE ratio. So just to get back here to the definition, dividend yield, you have, for example, an annualized dividend of $1, and this is then the amount which you divide through the stock price, and then you get the dividend yield. Payout ratio is the dividend as a percentage of a company's earnings. For example, let's say the EPS, so the earnings per share, net income is $1, while paying a dividend, let's say, of 50 cents per share. The payout ratio is 50%. Now, the thing is, 50% is already quite high. Generally speaking, the lower the payout ratio, the more sustainable a dividend should be, since the simple reason is you need to make money first and earn something per share to then pay out the dividend to your investors. The higher the payout of the dividend, or the higher the dividend you pay out to your investors, the more money you need to make, which is unlikely in an environment where your advantage, where your edge within your business sector in this case is not as high as it needs to be to pay out constantly a high dividend, resulting in a high payout ratio. And that's it. Let me just check out the chat box. Okay, yeah, thank you. So the question from Claudia is, where can I look that? You mean the webinar? The webinar itself? Well, you're in the webinar, so you're probably watching the webinar right now. So that's probably not what you're referring to. So no, you mean the dividend aristocrats, probably, where you can check this out. So all in all, I recommend just Googling dividend stocks. There are many websites out there who list these dividend titles, in fact. And since this can be a quite complex topic. In fact, that was the main reason why we had this list here of the metrics you should look at. So dividend yield, yes, very attractive, very interesting, certainly, but payout ratio is probably more when it comes to the question, is this sustainable? And also the earnings per share, the PE ratio. It's also probably interesting, especially for longer term investments, when looking at the balance sheet and the developments there. Yeah, just in case of the history of dividend payments, just check out the stock you want to look at, and then you have several sources on the internet. I just simply say Yahoo Finance is probably one of the most common, where you can just check out the stock and then have a look here at the dividend history in this case. So I don't know right now the URL, but most likely, if you check out Yahoo Finance, you will certainly find something on the dividend history here, the payment history in this case. So next webinar, Trading Spotlight webinar series, will be on Monday together with Paul. Paul will teach you to trade with the 20 period moving average in this case, so the 20 MA. And the webinar will include why is the 20 MA of interest for traders. How can we use it for both trends, but also for reversals? And then how does it play out in live markets? So Paul, I've seen the presentation. You will learn a lot. And I highly recommend you checking out the webinar. If you watch it on YouTube, please leave a thumb up here. If you just enjoyed what you saw, you can also check out the webinar page on the Admiral Markets website. So first of all of you right now here within the webinar can check their inbox in terms of, or in regards to the webinar link. It will be directly sent. It's an ongoing webinar, but we also have here, if you watch this on YouTube, the chance check out admiralmarkets.com. There, the educations tab and their webinars and trading spotlight. And there you can then register for the webinar. And that's the website, admiralmarkets.com. Here are the contact details. And at the beginning, I didn't mention it, but it's something which goes without saying. In fact, Admiral Markets is a highly regulated broker, several regulatory bodies, in fact, and that's why we have to have a look here at the risk disclaimer. That's it from my end. Have a nice weekend. Enjoy yourself. Talk to you again next week on Friday. I look forward to it. See you.